What's up investors, it's the Russian dude. In today's short video, let's talk about one particular indicator which extremely accurately predicted every single recession since 1980s. And this particular one is called the inversion yield curve of 2 and 10-year-old treasuries. According to this graph, which you can see right now on your screen, every single time this yield curve was exiting the zone of a so-called inversion, basically whenever it was reaching the positive territory, inevitably, every single time, once again since 1980s, this was the earliest warning sign for an upcoming recession, and eventually, in the short term, recessions were happening. And just to be a little bit more specific, historically, as soon as the yield curve broke into the positive territory, once again, according to this graph, at least 1 to 4 quarters maximum, this is when the recessions started to happen. And this time, we just broke into the positive territory once again, so let's see if this is going to be accurate prediction in the near future once again. And what is this inversion yield curve in the first place? Well, mainly it tracks the difference in yields between 10 and 2-year treasuries. Because in the very basic understanding, the longer the duration of a treasury, the bigger is the yield of this particular fixed income security. And it can be very easily explained because it is very uncertain what can happen within 10 years. For this very reason, the yields for example, 1-year treasury will not be as high for 10-year treasuries because many things can happen within 10-year period and not just once. And back in the 1980s, the economical expert Cam Harvey was the very first one who saw the correlation between this inverted yield curve and the probability of upcoming recessions. One of the main reasons to explain why is this happening is the significant slowdown in the credit activity by the financial organizations. Because banks, for example, they use short-term borrowings to finance their long-term financial operations. And one of the ways they make money, out of thousands different ways they do make money, is once again the difference between the spread of these short and long-term financial obligations. And obviously, as soon as this pretty straightforward financial formula breaks, this is when the economical activity starts to reduce, starts to fall apart. Another reason, whenever smart money in control of billions and sometimes even trillions of dollars collectively, whenever they see that there is something about to happen with the US financial system in the near future, they are no longer seeing these investments even in particular stocks or short-term obligations, short-term fixed income securities, because they know that something is about to happen, so why invest now when everything is gonna most likely decline in the near future? And this is exactly when they start switching their investments to more long-term financial assets, once again longer-term treasuries, and this is what increases the price of these, for example, 10-year treasuries, while decreasing their yields. This is just a few ways how this inverse yield curve can be explained and how it can potentially predict the upcoming recession. Even though every single financial expert, economist, they can always present their own views, but these two particular ones are one of the most frequent ones. But because we also spoke about this, the stock market, the financial system in the US is irrational. If every single thing will be following a black and white rule, it will be extremely easy for above average smart market participants to make money. But because of irrationality, every single crisis is different. Every single crisis is not exactly the same as the previous one, and every single crisis is triggered at a random moment. Not a single person with a 100% accuracy can predict for sure when it's gonna begin and when it's gonna end. For this reason, even though right now we are once again in the positive territory, we broke the inversion yield curve once again, so we are potentially due for another recession, but let's see, times are different. The Federal Reserve uses much more extraordinary, much more sophisticated financial systems, financial incentives, so this time something might actually be different, though personally I do think that we are due for at least some sort of correction. For this reason, even though the indicators, they point out that once again we are due for some downfall in the stock market, there is no reason to sell your entire portfolio, go into cash and wait for good opportunities. No. Personally, what I do, I just continue dollar cost averaging, and I'm very welcoming to such events, recessions, because it only means that I can grab my favorite stocks, my favorite ETFs at a very discounted price. So there you have it, guys. As always, thank you so much for watching. Please like this video, subscribe to my channel if this was interesting, informative for both, and see you tomorrow.